Hey everyone, welcome back to Bonds with Bundt. This is a weekly update where I break down what's happening in the bond market and housing data, and what it means for mortgage rates, buyers, and home sales. This week we had a lot of moving parts, Fed headlines, global noise, and some really important housing data. So let's walk through what actually matters. Last week, markets reacted to comments around who might be the next Fed chair. President Trump made public comments about potential candidates, and that alone was enough to move markets, not because of policy changes, but because uncertainty always creates volatility. The key thing to understand here is this: markets don't like surprises. Even before Powell speaks, the idea of a Fed chair announcement can move rates short term. That doesn't change housing fundamentals, it just creates temporary noise. Now let's shift to something much more grounded. The NAR Realtor Confidence Index showed realtors are more optimistic about early 2026 than they were about 2025. Some important takeaways: 16% of home sales still sold above list, cancellations stayed flat at 5%, nearly 1 in 5 buyers waived inspections, and average offers per home stayed above 2. And cash and investor activity remained stable. Yes, the days on market ticked up a bit, but December was impacted by holidays and weather. Overall, this is still healthy, competitive market, not a weak one. At the start of the week, we got another important headline. The FHFA raised the cap on how much mortgage-backed securities Fannie and Freddie can hold. Now that's important because it allows for more mortgage-backed security purchases and reinforces long-term support for mortgage rates. It aligns with efforts to keep housing stable heading into an election year. This doesn't mean rates fall overnight, but it does support lower rates over time. Midweek data confirms something we've been talking about for a while. Lower rates lead to more demand. Home price data from Case-Shiller and FHFA showed monthly price gains again. Year-over-year appreciation is still positive, a clear shift from declines to gains over the past few months. This lines up with what we've been seeing in applications. Purchase applications are up nearly 20% year over year. Refinances are also way up. Buyers don't wait for perfect rates. They move when payments improve. The Fed did pause this week, which was expected, but what's important here is that they're missing is real-time inflation data continues to cool faster than official CPI and PCE reports. Rent data is falling, wage pressure is easing, productivity is improving. On top of that, consumer confidence dropped to its lowest level in years, and layoffs continue to make headlines. This is not an overheating economy, which means the pressure on the Fed to cut later this year is still building, even if they pause now. We also had some government shutdown headlines late in the week. Markets barely reacted. Why? Because most of the Fed meeting outcomes were already priced into the market, and the data continues to point towards slower growth and easing inflation. Noise comes and goes. Trends matter more. Here's how I'd frame it this week with clients. For buyers, demand is already rising. Prices are responding to rates before rates bottom. Waiting can mean paying appreciation later. And for sellers, the market is healthier than headlines suggest. Buyer confidence is improving. Lower rates bring more competition, not lower prices. And for agents, this is a market where education wins. Short-term volatility creates opportunity. Clear guidelines help clients move forward. Bottom line is, rates don't move in straight lines, but demand is responding. Prices are stabilizing and rising. The housing fundamentals remain solid. If you want help walking a buyer or seller through strategy or running numbers for a client, just ask. Thanks for watching Bonds with Bundt. I'll see you next week.